Hello, everyone. Wishing you
Good
all a good
morning.
morning.
Good morning.
Yeah,
Welcome to the 126th webinar by Connected by BVA. I'm happy to see all of you joining this early morning, and I hope that today's session will be as educative as our previous sessions. I, as the president of BVA, am also delighted to announce that on 29th of November, we are going to hold our next another seminar in the city of Thrissur, Kerala, and I urge all members to join us there in what would be another exciting seminar by BVA. With this, I would ask Mr. Ravichandran to introduce the two speakers for today. Ravichandran ji,
yeah,
over to you, sir.
sure. Welcome, BBA members. Today, the topic is on accounting and valuation aspects of M&A and valuation of contingent liabilities. We have two eminent speakers today. One, Mr. CS Chandrasekhar, who is a postgraduate in commerce, company secretary, cost accountant, law graduate, qualified social auditor, and registered valuer and insolvency professional with over 22 years of corporate experience in reputed Indian and multinational companies. He is a founder of KC Shekhar and Associates, providing corporate advisory, valuation, secretarial, and insolvency services. A regular speaker at ICAA, ICSI, ICMA, and ICSI RVO. He has delivered sessions on corporate laws, taxation, insolvency, and valuation. He has also served as a corporate co-opted member of the Corporate Law Committee of ICMA. We welcome Mr. Chandrasekhar.
Thank you, sir.
Yeah. Today, the second speaker is Mr. B. Rajeswara Rao, who is a fellow member of Company Secretary, registered valuer, social auditor, and mediator with over 25 years of experience in corporate, secretarial, and valuation domains. A partner at BRKS Associates, he holds master degree in business laws from NLSIU Bangalore, and he has worked across private, multinational, and public sectors. He is also a regular speaker. The other side of Mr. B. Rajeswara Rao is he is a writer of English and Telugu literature and a spiritual enthusiast. We welcome Mr. Rajeswara Rao.
Thank you,
Now,
sir.
over to Mr. Chandrasekhar. Yeah.
Thank you, sir.
Yes, sir.
Thank you. Thank you.
Yeah. Very warm welcome and good morning to all. So today's session is planned by BVA covering accounting and valuation aspects of M&A and continuing with the contingent liabilities. See, both the topics are connected to mergers and acquisitions. BVA in the past conducted several sessions on PPA, purchase price allocation. Why this topic is selected is recently, I think you are aware, MCA has amended the section 233 fast track rules. Sir, am I audible, sir?
Yes,
Yes,
sir.
So with the
amendment,
with the amending the fast track merger rules, where earlier fast track merger under section 233 was allowed only for holding and subsidiary companies and small companies. Sir. With the changes in the recent changes where they wanted to uh, increase the speed of mergers and amalgamations for other than small companies, then they given a scope increased. And RD, so all mergers and acquisitions other than certain companies having borrowing more than 200 crores will go to RD. It means that there is a huge scope for practicing company secretaries, advocates, and other side is very importantly valuation. As you know, any M&A requires valuation. So valuation is not just what we have done traditional valuation. It is having a lot of, if you know the other side of a coin, how it is going to be impacted accounting and auditing, valuation will become much more, it take much more bigger role. So with this, so I'm going to discuss now for next 50 minutes. We'll not talk about the core valuation because everybody we are aware. I'll be discussing what is the relevance of valuation with reference to the company total valuation, how it is getting impacted goodwill, what is impact on income tax. So with this, sir, shall I share my screen?
please, sir, please.
So topics what we planned is like this. what is exactly brief about an M&A, mergers and acquisitions, overview of accounting aspects, amalgamation. Now we know the two sets of accounting standards are covered, Ind AS and IGAAP. Amalgamation is covered under AS 14. It has got two methods of accounting, pooling interest method and purchase interest method. We're not going to discuss accounting entries. We're going to discuss accounting method, how it is being, what are the methods available, what is significance of each method. So it has got a lot of relevance in terms of reserves and surplus, how to be recognized. Next, same M&A under Ind AS is covered under Ind AS 103. There also we have two methods, predominantly purchase method or acquisition method, common control transactions. So with this, we'll have accounting overview. What is the difference between AS 14 and Ind AS 103? Summary of both the methods, pooling interest method and purchase method. Then coming to our valuation aspects and income tax impact and goodwill, recognizing goodwill and identifying intangible assets. I think we in the past conducted several sessions on intangible assets and core. I'll be touching upon why we need to give importance for identifying intangible assets. If it is recognized, how it's going to be impacted on the company valuation and income tax impact. If not recognized, we have seen many people recently. We had one session, one discussion. They said ours is a state company, small. We are not a listed company, but we are Indians. We don't want any goodwill. So we don't want any intangible assets. We will recognize the goodwill. I'll discuss now when there is intangible assets, where the goodwill will arise. Goodwill will come only there is an inherent intangible assets. So we must recognize intangible assets. If we do not recognize, we are going to net worth is going to be eroded. So that is about we will be discussing about impact and its impact on income tax. So amalgamation, as you know, there is no specific definition under section 2. It's a general definition covered is amalgamation means it's in pursuant to section provisions of Companies Act 2013 or any other statute which may be applicable to the companies. So amalgamation definition is a very broad definition, is a generic. Same principles are applicable for demerger. So amalgamation, what happens? One company acquires other company, transferring company. Similar demerger also, one company merge, one unit will be demerged into other into a resulting company. In terms of accounting and valuation, more or less same principles are applicable. However, for income tax demerger, there is a different definition. Income tax defines demerger as transfer pursuant to scheme of arrangement under section 230 or 232. So as you know, any scheme is covered under 230 or 232. By demerged company offers one or more undertaking to any resulting company in such a manner. So that is a demerger. Conditions of amalgamation to be fulfilled. We will be discussing about what are the conditions. Accounting similar to AS 14. In case of demerger, there is only one method of accounting is permitted, that is a pooling interest method. Purchase method is not permitted. So as you know, corporate restructuring can take off any forms: acquisition, takeover, mergers, demerger, reverse merger, disinvestment, strategic investment, lump sale. So in all these things, which method to be appropriately selected, which is appropriate considering accounting impact, strategic decisions, and income tax impact. Now this M&A, if you wanted to see 360, see, when we go for amalgamation, we will be discussing as a company secretaries for only secretarial compliances, making an application to RD or NCLT, getting approval. But if you see 360-degree, what are the other things aspect? Very important aspects which we need to consider: income tax and stamp duty, GST. GST is also, though we are not discussing now, but whenever we go for a proposal or whenever we wanted to give an end-to-end advisory, we need to look at it. These are the three impacts, very important. See, getting NCLT approval or RD approval is one process that will happen. but impact to the organization and also stakeholders value is created when we take care of these things, stamp duty, income tax, and GST. Secretarial compliances, sectorial compliances, that is CCI, RBI, IRD approval in case if the companies are covered under sectorial limits. Accounting covered under AS 14 or Ind AS 103 and valuation aspects. This is one of the important area. Post-merger, change in the land records, surrender of registrations, assignment of patents and trademarks. So this is a 360-degree of any merger and acquisition we need to consider. Just each one is dealt with the different people. Valuation is done by register valuer. Accounting is done by account staff. Auditing is done by auditors. Secretarial compliance is done by practicing company secretary, advocate. But when we can create real value is when we see other side how it's going to be impacted. So when we do the proposal, we have to consider all these aspects very carefully. Though we are not masters in that, but knowing those nuances is going to create a lot of valuation, So with this 360-degree, we as a registered valuer will be taking a predominant role on the valuation. So today's objective is see what are the highlights and the nuances of other aspects. So we have a division 1 M&A. Now today's discussion, we are going to discuss accounting aspects and division 2 and valuation aspects. Before with this proposed discussion for next 45 minutes, I'll start with some of the basics, though everybody is aware, this is just a repetition. Accounting standards are applicable for either corporate or non-corporate. For any accounting, any transaction requires accounting. It requires a standard. So if there is no standard, you will follow their own process. There is no consistency. So accounting standards issued by ICAI are applicable to all corporates and non-corporates also. For a corporates, we have a division 1 IGAP, division 2 Ind AS, division 3 NBFC. So predominantly we are discussing about a corporate. Any company incorporated the Companies Act, whether paid up capital 10 lakhs, paid up capital 1 lakh or 1000 crores. Accounting standards issued by ICAI, notified by the MC is a must. Then in that there are three states. If it is NBFC accounting standards are applicable. If it is Ind AS, if it is listed company, companies having a net worth more than 250 crores, Ind AS is applicable. And for other companies, IGAP is applicable. Now, for non-corporates, though just I wanted to give an entire structure of this accounting standards. For non-corporates also accounting standards are applicable. Is not that it is not applicable. Whenever we go for an preparation of finance statements, accounting standards are applicable non-corporates. So there depends upon this threshold turnover. They define as a level 1, level 2, level 3, level 4. So coming to our accounting standard for corporates, listed companies, so as you know, for Ind AS is applicable for all listed companies and their holding subsidiary associate companies. For companies having less than 250 crores net worth, IGAP is applicable. So division 3 NBFC. So today we are going to discuss about a little more into the what is the accounting standards covered for M&A for unlisted companies and also listed companies. Discussing with two sets of accounting standards, IGAP and Ind AS. AS 14 covers amalgamations for non-Ind AS companies. Ind AS 103 covers business combination. In the AS 14, we got amalgamation in the nature. There are two methods of accounting. One is amalgamation in the nature of merger. Next one is amalgamation in the nature of purchase. Similar concept in AS 103, we got common control transactions, acquisition method. So this is a very important for an valuer to look at it whenever we do the valuation. Any number we arrive, how it is going to be impacted other side. So in case of AS 14, amalgamation in the nature of Purchase means where there is no, there are certain conditions are there notified under S14. If you can fulfill those conditions, then it is considered amalgamation in the nature of purchase. So pooling in the nature of merger, otherwise in the nature of purchase. We'll discuss those are the conditions. Similarly, India is 103 also there are two methods. Predominantly will be going for an acquisition method. Then we have a common control transactions. So in the amalgamation, AS14, amalgamation is the nature of purchase, merger, amalgamation is the nature of purchase. When we call it the amalgamation in the nature of merger means there are 5 conditions are there. What are those conditions? Any amalgamation which satisfies the following conditions is required to follow amalgamation in the nature of merger because there is no fair value concept in case of amalgamation in the nature of merger. What are the conditions? Transfer of assets and liabilities. Whenever there is an A acquires a company B transfer being a transfer company, they have to transfer all assets and liabilities without any exception. Next, 90% of the transfer company shareholders should become transfer company shareholders. Consideration to be paid only in the equity and the existing business of the transfer company to be continued. No adjustment in assets and liabilities value. If these 5 conditions are satisfied, whenever we do the valuation, when transfer company assets and liabilities, everything is taken over as per NCLT or RD order, 90% of the shareholders of the transfer company becomes the shareholders of the transferring company. Why 10% given is wherever some shareholders, minority shareholders, if they're not interested, they can give a consent, disinterested. So 90% is the must. Important thing is consideration. This consideration to be paid only in the equity. You cannot pay preference shares or cash. Then business has to be continued. No adjustment in assets and liabilities. So if these conditions are fulfilled, then we need to then yes 14 permits. You need to follow amalgamation in the nature of merger method. If one of these conditions, if any one of these conditions are not fulfilled, then it is called as amalgamation in the nature of purchase. So as per S14, if these 5 conditions are fulfilled, we have to go with the pooling interest method. Otherwise, we have to go for purchase method. This is a mandatory requirement. So, what is the pooling interest method? Suppose if all assets 5 conditions satisfied, then we are going to discuss method as an accounting pooling interest method. In that method, what happens? All assets are transferred at the carrying value. There is no revaluation. There is no fair value. All liabilities, including reserves, are transferred at the carrying value. So in this method, beauty of this method is assets taken over book value, liabilities taken over book value, reserves also considered in the transfer company in its own form. Purchase then difference between purchase consideration and the net assets is considered capital reserve. So in this case here, since a pooling method, in the pooling method we don't recognize any goodwill. So if the difference between assets and liabilities will be accounted as a capital reserve plus or minus. So this is a important method. In this case, no goodwill. Then example if you take here, just to clarify that, if a company has got 1,000 crores of assets, 400 crores of liabilities, then 600 crores is an so if the company has got 1,000 crores of assets, 400 crores of liabilities, then difference is 600 crores is the net assets. For the net asset of 600 crores, if the transferring company pays consideration of 400 crores, then they're getting a benefit. This amount will go to capital reserve. So purchase consideration, if it exceeds a net asset, then this will become capital reserve. This is a ES14 pooling interest method. The same situation, option 2, instead of 600 crores, if they pay 700 crores. So what happens if the purchase consideration is more than the net assets? Any views? When purchase payment is made more than the net assets?
Goodwill, sir.
Yes, sir. So in general, it is a goodwill. But since it's a pooling interest method, generally when a purchase consideration exceeds net assets, is a goodwill. However, under the pooling interest method, goodwill cannot be recognized. So you must have seen that's the reason in the reserves we'll have negative reserve, negative. So in this case, this when I am acquiring assets of 600 crores, 600 crores comes on the asset side. I am paying 700 crores. 700 crores will be recognized as a share capital and share premium. The difference of 100 crores is recognized instead of goodwill. It is recognized as an amalgamation reserve with a negative value. This is a because we are following a pooling interest method. In the pooling interest method, goodwill, because pooling interest what? Same assets, same business is continued, same shareholders have continued. Then you cannot recognize goodwill from your own business. Then it will be recognized as a negative capital reserve. This is not so about AS 14, two methods, 5 conditions satisfied, amalgamation is the nature of merger, pooling interest. In the pooling interest, only capital reserve plus or minus, no negative. In case of next one, in the previous one, if it is a purchase method, goodwill. Yeah. Now, if any of the conditions is not satisfied, then that is called as amalgamation nature of purchase. In this case, amalgamation nature of purchase, what happens? Account treatment or purchase method is as follows. Transferring company recognizes assets and liabilities of transfer company at fair value or book values as depends upon what is it? Uh, uh, allocation will happen. Purchase price allocation, total amount paid depends upon how much to be allocated to each assets. So closer to the fair value. Here the drawback is reserves are not taken over. Since in this case, some of the conditions are not fulfilled as per amalgamation, so then it is treated as a purchase of business. In this case, it's very simple. If a purchase consideration exceeds net assets, difference is a goodwill. If a purchase consideration less than net asset, difference is a capital reserve. This is a general principle is considered. So just recollect these four methods. Say whatever is then AS 14. Similar methods have been considered in India's 103. That is called business combination. But the business combination, the definition coverage is huge. In case of AS 14, it covers only amalgamation. What is amalgamation? A takes over business of B. Then that is amalgamation. Then only it is applicable AS 14. Business combination is much more. Assuming that there are A acquires 100% equity shares of a B Limited. So business they have not taken over, but they have taken over the control. So even the control also in such a case, business combination is applicable. So India's 103 combination, business combination, accounting standard, is not restricted to the only direct amalgamation, merger and amalgamation. It is also whenever you take over the business through control. So the broad coverage is more. What is business combination? A business combination is a transaction or the event in which acquirer obtains control of one or more business. So whenever we here the word they use is control. So it means that whenever we acquire the control, more than 50% controlling power in another company, even though there is no amalgamation per se, then India's 103 is applicable. Control they define, I think, as defined in the section Companies Act, where is having a investor controls a investee if only when a power he is able to control the management of a decisions. If the transferor, if the transaction or assets acquired are not business, the reporting entity shall account for the transaction or other event as an asset acquisition. Here, one thing is we need to differentiate is we said control over whenever acquirer controls the business, then India's 103 is applicable. We need to differentiate is it a business? Is it asset acquisition? Assuming that is the what we acquire is a business, then we have to follow. Or what we acquire is not a business, it is only asset, then asset accounting has to be followed. The difference between asset acquisition and business is asset is in one asset or concentration of uh, activities is related to one only particular asset. Business is a wider one. It has got input, it has got process, it has got output, so it has got employees. So we need to differentiate, is it any transaction? Is it asset acquisition or business acquisition? There can be situation, as we discussed, if A controls the business of B more than 50%, then business combination. However, B should have business. There can be situation B has no assets, no business. B has only investment property, or so B has only land bank. 100 crores land is there in the B, and A, instead of acquiring the land, they are taken over the entire shareholding of a B. In such a case, we can't say that is a business combination because B has no business. B is having only land bank of 100 acres. A is taken over the land. So the land is not a business, is an asset. So that's what we need to differentiate here. Is it asset or business? Hello? So under India's, again, the same methods are there. Acquisition method. When coming to once we differentiate, is it an asset or business? If it is asset, we have to recognize it in PPE, asset acquisition. If it is a business, we need to follow acquisition method of accounting or common control transaction. In this case, acquisition method means this is like a purchase of business. In this case, we'll be going with the assets. All assets, unlike AS 14, there are no 5 conditions to be followed. Here, whenever business is taken over, is it what we need to test is a business. Business input, process, output. If you taken over control of the business, then Ind AS 103 is applicable. 103 is applicable on the date of taking over the control. How to recognize assets and liabilities? Assets recognized at the fair value. Liabilities recognized at the fair value. Difference between asset and liabilities recognized as a goodwill or bargain purchase. So this is a predominantly followed difference between a good purchase consideration, net assets is a goodwill or bargain purchase. Okay, now this is very important. I think I'll be requiring some inputs from members also. Whenever we said difference between purchase consideration and net assets is goodwill, whether to be intangible assets not recognized, intangible assets recognized, how it's going to be impacted. There can be a situation, as we discussed in previous session, previous slides, there is a company A, it has got non-current assets of 500 crores, 400 crores of, no, where just now the business is taken over in our previous session, net assets is 600 crores, 500 crores non-current assets, current assets 100 crores, but they paid consideration of 1000 crores. What happens plainly when a purchase consideration more than the assets, 400 crores is recognized as goodwill. Now, same thing, instead of recognizing goodwill, we have other options. Same option. Intangible assets in this case not recognized. In this case, they will recognize. The 500 crores PPE has become 500 crores. 400 crores we are paying here. Now tell me now, when assets are only 600 crores, if they're paying 500 crores, what is exactly, is there intangible, are there any intangible assets, inherent intangible assets are available to the company or not?
If it is
No, I
less,
think,
if it is less consideration, where is the intangible assets?
no, I'm paying more. See, assets 500 crores. See, I'm saying transaction here. Assets acquired is 600 crores. Purchase consideration paid is 1000 crores. So in this case, the difference is called, we normally call it as a goodwill. Now tell me, when we are paying 1000 crores for acquiring assets of 600 crores of a tangible assets, which is visible, 400 crores, which is invisible, intangible assets, does it exist or not? No, just I wanted the inputs. When the company we are paying 1000 crores, definitely inherent intangible assets are there, no? So I'm coming to here now. Same company, what is our valuer rules? Today's our purpose is goodwill can be recognized when I'm paying 400 crores means it means that it has got intangible assets. What is intangible assets? As we discussed in previous sessions, many sessions, customer contracts, trademark, brand name, assembled workforce. There are so many factors which is not identified. So assuming that there is a situation today, we'll take Swiggy or Zomato. Their assets are physically no, very few, but their business is in only customer contacts. So if a new company take over, they will not pay only for assets. They'll pay much more than the assets because of their network, because of their um, connectivity with the customers and also their aggregators. So that is called as we call a difference between the goodwill, but the goodwill will not be paid unless there is the intangible assets are there. So here we coming here, same company, we are going to recognize 300 crores. How we can recognize assembled workforce? So tomorrow if a Swiggy is taken over by another company, he can start a business, continue business immediately next day. So what is generating business tomorrow immediately is because of his network, because of his access connectivity. So that is called as a employee assembled workforce or it is a brand. So these are the things are recognized. So in this case, what's happening is in this case we recognize 300 crores as the intangible assets one way. For a while, assume that this is not there. In this case, what is the net worth? 500 crores is the assets, 100 crores is the current asset 600 crores minus current asset 400. 600 minus 400 is a 200. 600,000 minus 400 600 minus 400 goodwill. So in this case, same situation, net worth is 200 crores. Because when you say net worth, total assets minus liabilities minus fictitious assets. So in the first case, my net worth is only 200 crores. When I recognize intangible assets, then my net worth is 500 crores. What happens? 100, 500 plus 100,000 minus 400, 600 minus 100 goodwill. So by recognizing intangible assets, we are going to bring its assets in the form of an identified asset, which will increase the net worth. So there's a difference between one of the thing is recognizing and not recognizing has got impact on our net worth also. Any person, if you see the financials of any company, if the company has got goodwill, it means that it is a fictitious assets, they paid more than what they have acquired. So net worth to the extent will get eroded. So there is a need to recognize intangible assets. As a valuer, we have a role in increasing net worth from 200 crores to 500 crores. How? By identifying 300 crores of intangible assets, various forms. So that is a very important to, hence intangible assets valuation, recognition, accounting has got a very significance. So this is about we are saying in the Index 103 business combination. This is a method as we discussed. If assets acquired are 600 crores, consideration paid is 400 crores. The difference is considered as an since I'm acquiring more than the what I'm paying, then it's a gain and bargain purchase. If you purchase consideration less than net assets, is a gain and is a bargain purchase. Similarly, option 2, if I acquire 600 crores, if I'm paying 700 crores, is a 100 crores is a goodwill. Okay. Now we discussed both methods under Ind AS under 103, pooling interest method of accounting and purchase method or acquisition method. We discussed pooling interest method. Everything assets and liabilities taken over. Reserves, its nature, its identity is recognized. What happens in a common control transaction? Common control means where controlling entity before and after acquisition is remains same. In any business combination, where all combining entities or business are ultimately controlled by the same party or parties before and after, the business, it is called as a common control transaction. What is common control? Parent company restructures its business. So like this, A is in a holding company having 100% stake in B Private Limited. Similarly, 100% stake in C Private Limited. So in both these companies, B and C are controlled by A being ultimate holding company. If a C acquires B Limited, this is called a common control transaction. So B and C earlier were controlled by A. Now C acquires the business of B. Ultimately, though C there's an business combination, but ultimately controlling party is A. Then there's a common control transaction. If the common control transaction, accounting follows very simple method, pooling interest method. So when a parent company restructures its business under the same group are combined, common control. In a common control transaction, what happens is reserve treatment, same treatment, ES 14 and INS 4 in the pooling interest method. Identity of reserves is preserved. That is general reserve scheduled minimum account. What happens in a common control transaction? Assuming that in our same situation, here B has B has a 100 crores of free reserves surplus. C also will recognize 100 crores as an reserves and surplus. Impact of this is if surplus is the 100 crores of B, C also will recognize surplus so that this surplus can be used as for payment of dividend. In case if the pooling method is not followed, the purchase method, the surplus will not be recognized. So that will go be that it will disappear in the transferring company. So in case of common control transaction, reserves and surplus, its nature and also its identity is preserved, which will have an impact on other things. So example, continuing the same situation, X Limited has a surplus balance in the P&L account of 10 crores. The surplus of 10 crores will be transferred to Y Limited as it is. So Y Limited transferring company can distribute it as a dividend. So whenever we are doing a transaction, if a transfer company has got huge surplus, which is available for its intended purpose, especially for dividend, if it is a pooling interest method is followed, permitted, transfer company recognizes same surplus as the same amount. Benefit is transfer company pay this amount as a dividend. In fact, we had one transaction where pooling interest method they did not follow. The surplus has lost its interest, its nature, then it has become an capital reserve. Because of that, company has got a huge amount, but they are unable to declare the dividend. They are going for a reduction of share capital now. So this is was you discussed 360-degree. When transfer company has got 100 crores of surplus, if a transferring company doesn't fulfill the requirements of pooling interest method, it goes purchase method. In the purchase method, surplus of a transfer company will not be carried out. It will be recognized capital reserve. Capital reserve cannot be paid as a dividend. Wherein we discussed in the previous in this session, if B has got 100 crores of surplus, C, if it followed 100 crores pooling interest method, the 100 crores can be distributed as A Limited. Since if they follow, that's the reason they permitted the common control transaction. Assuming that if the common control is not there, A is holding only 60%, B is holding 40%, is not a common control. In such a case, B Private Limited, the surplus, it changes its identity, then they can't distribute as a dividend. So then, and if not a dividend, there are other impact, capital gain, other things also there. So this is about the what is the common control transaction? We said discussed already. We already covered this. Okay. What are the key difference between ES 14 and India's 103? Though we discussed predominantly accounting and its impact. Key differences are like this. Applicability, when ES 14 is applicable, is only pure mergers and acquisitions under 230, 233 for a smaller companies other than India's. This is applicable to all business combinations. So we discussed it's a wider definition. This need not be M&A. This is a control. Accounting method, here also two methods are permitted. India's predominantly acquisition method, except pooling interest method is followed in case of common control. Common control transactions is recognized under only business combination. Coming to accounting, the scope is limited to, okay, this is not required. Okay, and in both the methods are like this. Pooling interest method, purchase method, we discussed. It is a summary of what we discussed for last half an hour or so. Assets and liabilities are recognized in the pooling interest method. Book values, here fair values. Goodwill capital reserve, pooling interest method only capital reserve plus or minus, no goodwill. Here goodwill capital reserve. Reserve surplus, pooling interest method, transfer to transferee company. Transfer in the acquisition method will not be taken over. So this is a summary and extract of both the methods between pooling interest method and purchase method. Okay. So we just recollected AS14 two methods, applicability, business combination. If you can just recall whatever discussion we had, I think I'd be recording the inputs from participants. This is like an recap. AS14 is applicable to, is it all forms of business or only M&A, asset acquisition, acquisition of subsidiaries, associates? So in terms of application, what we discussed, when you say AS14, is it applicable for all business combination or M&A or asset acquisition? I think any response from the participants?
Only M&A.
Option B.
Option B. M&A and
Okay.
demerger.
Yes, sir. Thank you, sir. I think in the sense you are very active. Whatever I said, you understood. So M&A. Next one, Ind AS and 103 business combination occurs when acquirer controls business or assets acquired without business. Okay, I think
B.
yes. So A or B, sir.
B only.
Ind AS
First one.
103. Yes. So Ind AS 103 is applicable only business with the control, not asset. As you discussed, though you acquire company B having no business, only land, is the asset acquisition. So when you want to go for 103, then there should be a business. This is simple question. This two methods are there. Under Ind AS 103, primary accounting method is pooling interest method, amalgamation method, acquisition method. Though, yeah, though two methods are there, predominantly primary method is acquisition method. Common control, the pooling interest is followed for acquisition.
See.
Business combination under common control are dealt with. I think this is AS14, Ind AS 103 appendix pooling interest method, Ind AS 103 acquisition method, not covered in either of the standard.
C.
So, sir, actually C is correct. B is also appropriate. I think this is a little for a common control transaction under Ind AS 103. Appendix C is specifically covered for pooling interest method. So I think this is we are not covered. Right answer is B.
Oh.
Sir, Ind AS under AS14 purchase method, not pooling interest method. Assets and liabilities are usually recorded at fair value, book value, net realizable value, or replacement cost. AS14 asset this is purchase method, not in the nature of a merger. This is a purchase method.
Purchase method, fair value.
Yes, sir. No.
Book value,
Okay.
watch out.
Slide. No. Fair value is correct. And the answer is wrong. This is a fair value. I think I have to correct it. You are right. Fair value.
Okay.
Purchase method fair value. Pooling interest method book value.
Okay.
Under Ind AS 103 acquisition method, assets and liabilities acquired or recorded at Ind AS 103 acquisition method, not a common control transaction. Assets and liabilities are recorded at historical cost, book value, fair value on acquisition date, fair value on the balance sheet date.
Fair value on acquisition date.
See,
Yes. Yeah. Thank you, sir. Acquisition date. This is general one, not required. These are all okay. So I think we discussed little away topic of accounting standard. Coming to our valuation, we'll just I'll be giving a brief. So, otherwise, anyway, I think all valuers we know for core valuation principles I know, but some aspects I'll be covering which is connected to the M&A. This no need to discuss market approach, income approach, cost approach. Yeah. Now I want to discuss for 5 minutes on this income tax impact and goodwill. As we discussed, goodwill impact on valuation and net worth. Now next impact is an impact income tax impact and goodwill. When we create goodwill, when purchase consideration more than the net assets, goodwill will not be allowed for tax purpose as a deduction. After 2021 Finance Act, there is an amendment. Earlier, goodwill was allowed to be amortized. Now, after 2021, goodwill is not allowed for income tax. So, in our previous discussion, if a company is recognized 400 crores as a goodwill, then every year we have to do impairment in the balance sheet whenever there is an audit, but you will not get any tax shelter. But by recognizing those goodwill as intangible assets of 300 crores, 300 crores will be amortized over a period of 4 years. Every year, 75 crores, you will get the tax shelter. So, goodwill can be recognized as intangible assets. As we discussed, in what form? Either customer list, contract, customer contract, brand value, assembled workforce, which can be amortized over a period of 4 years. So what's happening is, if the goodwill is not properly documented, and recognized, in our earlier case, out of 300 crores, we will get a tax benefit. Create intangible assets gives a tax benefit, amortized in 4 years. This is more advantageous than recognize the difference in goodwill. So just as I started with session, people say, no, I don't want all intangible assets. Whatever I recognize, I don't mind recognize goodwill. So we are not creating any value. So we need to identify the intangible assets. Finance Act 2021 amended, wherein it says goodwill will not be allowed for amortization. There is one also case law is there. United Breweries Limited versus the DCAD in 2022. After this amendment, this is Bangalore ITAT, they given there is a recent case law on this. Okay, so I think I would like to just conclude. This is what our summary we have done. Other valuation report concepts are connected to M&A. Valuation report is mandatory for M&A transaction, except holding company and its wholly owned subsidiary. Valuation shares of both the companies is must. When it will be joint report will be issued whenever there is a valuation report is there for M&A. We will be doing a valuation of a transferring company. A combined report will be issued addressing to the directors of both the limited, both the board, transferring company. We need to use appropriate methods for evaluation, not a single method. We also need to consider minority interest while doing the evaluation. What is impact on minority interest? Because if a common control transaction, valuation has got less significance because there is no goodwill recognized, there is no minority shareholders. If it is a acquisition method, there are multiple shareholders are there, majority controlling and also minority interest. So minority interest needs to be considered. Whenever there is
Sir,
a
I have a
cross-holding.
doubt here.
Yes, madam.
Specific reference will not be there in the valuation report with respect to minority interest. Net. We just have to understand whether minority interest is getting affected or not. Correct?
Absolutely. As you said, minority shareholders, when we do the valuation, we need to see the shareholding pattern. If there are minority shareholders, since they will be impacted, we need to ensure that fairness with utmost care. With a common control transaction, as we discussed, since ultimately only regulators are impacted, but not the shareholders. In case of minority shareholders, as we as you said, there's no specific mention in the valuation report, but we need to consider those factors while finalizing the report. Cross-holding, if any shares are there, it needs to be cancelled. Shares held by the transferee company in the transfer company prior to amalgamation needs to be cancelled. And
I
that
have a
we,
doubt here once. When we talk about this cancellation, this automatically happens, but as a valuer, when I take the share exchange ratio and take the absolute value divided by number of shares, and I have this value per share, that time this cross holding I will totally ignore it, right, as a valuer.
transfer company, yes, I'll ignore. We'll ignore, but what happens now when you do the entire valuation, they will see what is the cross holding, what is the value, so what is the pre-holding and post-holding. So there will be some discussion. So if we cancel, what will be the post-holding of the transfer company and the shareholder? So though plain answer is correct, valuation will not be considered.
More than cancellation, here interest will come. Suppose say A Limited is holding 5% in B Limited, B Limited is holding 5% in A.
Yeah.
Then when you are valuing A enterprise value, how to adjust that 5% in B? How to adjust that 5% in A? That requires little bit R&D
Yes.
to
Yeah.
add back that investment value to arrive at share value.
Yes.
That is
Also,
the
yeah, there are two methods are there. We can use that what the elimination method, how we used to do in the costing, no? Then but Excel permits. As you said, Excel. A is holding say A value 1,000 crores, B value is 200 crores. A holds 5% in B holds 5% in A. When A holds 5% in B, 200 crores, so that amount has to be considered. I think if you do the table, no, there is a method in a formula in Excel, it considers that needs to be taken care. But at the end, shares has to be eliminated while allotting the shares to the shareholders of the transfer company. Most important, purchase price allocation is to be done for accounting M&A under Ind AS. So I think we had many sessions on this PPA, and that is a process of accounting, what we discussed 103. So as other points, this is not connected to valuation. For M&A certificate from our statutory is required. Stamp duty. One point in M&A, we need to consider GAR, this General Anti-Avoidance Agreement. Whenever we do this M&A transaction of big tickets, GAR will likely to get impacted if there is any tax evasion other than tax planning. So that also needs to be considered. So these are the key discussion we had. Yes, 14 discussions, two methods. Yes, Ind AS 103, goodwill and capital reserve, how it impacts accounting, payment of dividend, tax impact. Yeah, so these are all summary of my discussions. If any questions are there, I can take it up. Otherwise, I think we should proceed with the Rajeswara Rao's discussions.
Anytime the valuer was summoned in the M&A, either RD office or any of the participants also, if they have any such experience, please share with all of us.
Yeah.
Chandrasekhar, see, you said that taking care of the minority interest, no?
Yes, sir.
What we have to do actually, I mean,
Agreed. Agreed, sir. What I'm saying is, if a minority's interest is say around less than 10%,
okay,
if they're not agreeable to the valuation, they can go to NCLT saying that questioning the valuation. There more fairness. When you say where do the valuation, is it real valuation? This what she is asking. No, if the valuation is done on not systematically, the values are not properly, then NCLT may question. When they'll question, when minority shareholder objects to the valuation less than
correct.
10%. So appropriateness, we need to have documentation. Second thing is that value is acceptable. If there's no minority interest, if the common control transaction, then will not be because the single shareholder, no, they may
Correct.
not be interested, but regulators are interested. Yes, sir.
Okay.
So yes, sir. Any more discussions? So as discussed, this M&A is a very big topic. In that we have taken a very small topic we deliberated, but it is a very difficult to digest immediately. I covered a little broad concept. In spite of that, I made try to made an little attempt to make clarity to the members and also create importance of recognizing those goodwill and other things in our valuation, recognizing so that we can add value. So with this, I thank all participants for listening and also adding value. And yeah, over to the BVA and
Yeah.
Rajeswara Rao.
Thank you, Chandrasekhar, setting the tone for my session.
Yeah.
Before starting my session, I would like to thank BBA for giving this opportunity, as well as Harish Damija sir providing some material to prepare for this session. And I'll be covering only theoretical aspects, concepts, and practical session is being planned at BVA that will be announced separately. Generally, contingent liability is an off-balance sheet item. It will be disclosed part of accounting notes or accounting notes only, because that liability is not crystallized. It will be crystallized upon occurrence of certain events in the future. Current liabilities, contingent liabilities are obligations that arise from a particular discrete events that may or may not occur. A key aspect of such liabilities which distinguishes them from current financial liabilities that one or more conditions or events must be fulfilled before the financial transactions takes place. The most common example of contingent liability is product warranty. If you purchase some mobile, laptop, or electronic items like that, for common this one I'm giving example, they say 1 year warranty, guarantee, or extended 3 years warranty, all those things, those are like they'll book it as a sales in your this one, but they may be disclosing in the off the balance sheet item saying that there is a contingent liabilities towards this product warranty extended for 3 years or 4 years or 5 years. Other examples, like if you have given corporate guarantee to your subsidiary company or associate company or joint venture company or group company, liquidated damages means, suppose, so you are signing a contract which is to be executed within 12 months. If you are going beyond that, say 16 months, for that 4 months extension, there will be some damages you have to pay, that is liquidated damages. Outstanding lawsuits, if any lawsuits are filed against you and you are fighting in the court, and government probes like GST department probe or income tax department probe or SEBI, like the or MCA, some show cause notices issued and they are telling that this is the liability you have to pay. These are like not crystallized, but it will be disclosed in the notes to accounts as contingent liabilities. Why it is required? Why they'll disclose? One is full disclosure principle. Suppose someone is reading your balance sheet to invest in your company, they should have entire information to assess what is the financial condition of your company, whether there will be any hitch in your cash flows in the future, whether there will be some uh, disturbance to your business operations. This kind of analysis or assessment will be happening to investors, like before investing into the equity or some other securities of your company. For that reason, it is required to be disclosed in your balance sheet, which will give you true and fair view of the balance sheet as required under 129, 130, like of Companies Act also says that we need to disclose balance sheet in a true and fair manner. For that principles, we need to disclose contingent liabilities in the balance sheet. Impact of contingent liabilities on valuation. this will definitely will impact our valuation when we are giving valuation reports to any established entities over like 10 years or 15 years. We need to look at their balance sheet in totality. If you are ignoring their off balance sheet items, then we may be committing mistake. There could be like contingent liabilities disclosed in a transparent manner, otherwise disclosed in a story which will not exactly disclose what will be the liability, but they would have disclosed it saying that yes, there is existence of contingent liabilities that we need to go through thoroughly to assess whether there will be a cash impact on future cash flows, and which may impact our enterprise value and per share value also when we are calculating. So there is an impact of contingent liabilities on valuation. We need to take care and we need to thoroughly study their balance sheet and P&L account and other notes to accounts. Applicable standards on recording and valuation of contingent liabilities. India's 13 prescribes on disclosing the contingent liabilities in the balance sheet. IVS 105 of IVS 2025 is mandating on like how we have selected a particular model to value our contingent liabilities. That process we need to disclose in our valuation report. In general, like what will happen, few assignments may come up for us to value exactly intangible assets, sorry, contingent liabilities. But when we are giving our full-fledged valuation report, when we are quantifying or crystallizing contingent liabilities for the purpose of arriving at enterprise value, at that time, how we have selected a methodology, what is the basis we may have to disclose as an annexure to our valuation report. There, like we need to disclose about this IVS 105. Methods for valuation of contingent liabilities. If I'm rushing, people can stop me and ask for queries, anything. Then and there we can discuss and move forward.
Rajeshwar, under what circumstances we have to value this contingent liability?
So there are no particular circumstances. Suppose say ABC Limited has come for valuation to you. You are valuing that enterprise value of ABC Limited to arrive at like a per share value. Then on going through, you have seen certain contingent liabilities they have recorded in the balance sheet. For example, to say that like there is a tax demand 200 crores, they have written saying that we have received demand notice for 200 crores for assessment year 21, 22, 22, 23. But we went to ITAAT where this appeal is pending and we have obtained a legal opinion. They have indicated that likelihood of this demand may be 10%, 20% you may be forced to pay, which means that when this appeal is disposed of by ITAT in say 26, financial year 26, at that time you will be forced to pay say 10 crores or 20 crores to the income tax department. That will hit your cash flow situation, like how we will calculate free cash flow to the firm. That may be impacted.
Rajeshwar, can I
For
add some
all
point?
transactions. Yeah, sorry.
Rajeshwar, can I add one more point?
Huh.
Okay. So, sir, this contingent consideration valuation, as I said, one is the other factor. Second thing is in our M&A transaction also, merger and acquisition consideration, there are three ways of consideration. Immediate payment on the date of acquisition, full payment. There can be a situation, deferred payment, saying that we agree for this amount, I'll pay after 2 years, some amount consideration permitted. Third one is contingent consideration. That is taking very important. That is another purpose of having this both topic today. What happens? I'll say at the time of acquisition, M&A, transfer company management, they promises many things. We'll do this company. We have intangible assets. What they will do is purchaser. I'll pay out of 1,000 crores. You said that you are going to achieve this company. I'll pay 600 crores now, 200 crores next year. Another 200 crores is contingent on achieving certain parameters. So my sales achieving X amount, EBITDA achieving X amount. So contingent consideration. So in M&A transactions, and now contingent considerations become part of it. So those consideration depends upon achieving milestones. So and hence there is a need for contingent valuation identification. Yes, sir. Rajeshwar, sir, you can.
Sir,
Can I add? Can I add?
yes, sir, please.
So in 103, we have come across the valuation of contingent assets also. You know, we are discussing contingent liability, though we should not ignore, not, we should look into the contingent assets also. So that term is used in 103, so that we can discuss it separately. But just to add, in addition to assets, in addition to liability, there are assets also,
Yes, sir.
which are to be valued by the registered valuer or the other valuers.
In all transactions, sir, be it M&A, be it
Sir, any transaction,
any acquisition.
Sir,
The when you have a merger and acquisition, especially you have to account for a contingent assets. But in normal cases, the contingent assets are ignored because we are preparing the accounts on conservative basis. That is why the contingent assets are never brought in a regular manner. Whenever there is a acquisition and merger, only through this process you can bring the valuation of intangible assets, as rightly discussed, the customer relationship, the good, these days it has been explained that goodwill is, these days it is being ignored, because earlier we used to get the benefit of income tax. So recently, in the past, maybe 3 or 4 years ago, they deleted. They said, no, you will not eligible to get the depreciation on the goodwill in income tax. So therefore, people are asking for a valuation so that the goodwill amount will get reduced, as it has been explained, earlier. So just my point was, with respect to contingent assets. Thank you, sir.
Yes, sir.
Sir, to add to Chandrasekhar point here, regarding this deferred consideration payable in case of acquisitions, like we need to look at it like the transaction document. There could be two possible scenarios. One possible scenario is A Limited being acquired by B Limited. Then B Limited is promising to the promoters of A Limited saying that we'll pay you 10 crores now, 5 crores after 1 year, 5 crores depending on A Limited achieving 50 crores turnover. Here we need to see from where they want to pay, whether they want to pay from B Limited or they want to pay from A Limited, like as a remuneration or as a compensation. Based on that, we need to consider this contingent liability, like accounting for our valuation purposes. If it is from B Limited, we are valuing A Limited, it may not materialize. If it is like from A Limited and we are valuing A Limited, then we need to crystallize and materialize and move forward.
Yes, sir.
Now, methods for valuation of contingent liabilities. Predominantly, there are three methods. One is probability discount method, insurance cost method, option pricing method. Again, option pricing we'll discuss later. Probability discount method, for example, we are giving product warranties. To be more precise, Samsung is selling their Galaxy Ultra 25 in Bangalore, say 1 lakh units. They're giving 3 years product warranty. Past incidents are like out of 1 lakh units, only 10,000 units came for repair within 1 year. So that probability is 1% or 0.1%. That kind of probability we need to estimate. What could be the probability of a product coming for repair, or we are going to incur expenses on the same. Use that probability on possible liability created. Possible liabilities, 1 lakh pieces we have sold. Suppose one piece is coming for screen replacement, could be 17,000 rupees cost. So 17,000 into 1 lakh, that is the probability of a liability, but in that only recurrence is 0.1%. That could be our contingent liability, what we are arriving at. This is probability, value of contingent liability will be face amount of liability multiplied by likelihood of occurrence. This is one of the method to arrive at the contingent liabilities. Option pricing methods, again, like one of these methods, we can choose Black-Scholes, binomial or Monte Carlo simulation. One of these methods we can choose and work out what could be the contingent liability. I'm not dwelling upon much on these three methods. Okay, insurance cost I missed. Insurance cost is like, again, in India it is not so popular. In foreign countries, if they're giving product warranty, they may take insurance to cover that. Otherwise, if you look at like no our vehicle insurance, we will have third party liability insurances more than our vehicle insurance. Third party will be more costly after 10 years or after 10 years of our vehicle life. That is like if you meet some with accident or something, some party is getting damaged, their property is getting damaged, you are paying insurance for that. Likewise, products also they may cover it for third party liabilities. For that, they may take insurance cost. For example, I was working for a company where they want to take third party liability of $5 million. For that, 50 lakhs is the per year insurance premium. In that kind of, that is an MNC. In India, no one was giving. We took it from some foreign insurance company. So that kind of insurance cost, if you are taking, contingent liability can be assessed based on the insurance cost, but it is not so popular in India. People will use probability discount method or option pricing methods.
Rajeshwara,
Huh?
in this insurance cost method,
Hmm.
aren't we actually shifting the liability because we believe that there is a risk that is inherently there in the business? We are shifting the risk, to the insurance company by buying a, cover for the insurance. Should we
Correct.
still also, I mean, insurance cost will be the only cost which will be a determinable cost for us, right? So
Correct.
should we still,
If they have taken already insurance, we need not account for that in as a contingent liability because already impacted our cash flow situation.
correct?
Generally, like if that is not happening, then we may look at like competitors, how much insurance they're paying, that kind of liability coverage. Then that can be arrived at what would be the contingent liability. But in general, in India, this is not so popular.
Okay, my question is, should we ascertain the insurance cost or should we ascertain the liability? Because they are two.
Insurance cost. We should ascertain the insurance cost. Suppose say to take this Samsung phone model only, to service 1 lakh mobiles for any damages next 1 year, they have a liability of say 17 crores. For that, they've obtained insurance and paid only 17 lakhs to the general insurance company. So the cost to the Samsung is only 17 lakhs because they like, as you said, they like relinquish their liability by obtaining a insurance cost. But suppose a carbon mobiles are there, they're not obtaining insurance towards this servicing. Just they're selling and they're giving 1 year warranty. Now we need to assess the contingent liability for carbon mobiles. When we are assessing, then in that case, we can take example of Samsung. Okay, this will be the insurance cost like that. But that may not be work out also. We may have to go for probability discount or option pricing also.
Okay.
That's the reason I was telling it is not so popular method in India because no one is follows in spirit of this taking insurance for liabilities.
Okay. Thank you, Rajeshwara.
Sir,
Next one.
sir, one question. Sir, can the company see the past, expenses done by Carbon Mobile in case of,
That only I was telling probability discount where we will see past how much money they incurred on this repairs and warranty provision.
okay.
Suppose say, across India they sold 10 lakh units, all the segments. They incurred example 1 crore towards this repair charges and warranty period. Next year they're selling 20 lakhs units. So probably like we can say
10%.
10%, 2 crores.
Okay.
Like that we can assess and provide for contingent liability.
Okay.
Okay. Whether valuation of contingent liability is mandatory in cost approach only? My answer is no. Any approach, this impact to be provided, whether it is cost approach, otherwise market multiples or market method, other is income, whatever approach you are choosing, based on that, whatever method you are choosing, this to be considered and provided appropriately. How to adjust the arrived contingent liability on equity value? Depends on the approach we are using. If you are using cost approach, then definitely after arriving at equity value or enterprise value, we need to adjust that one. In case of market approach also, after arriving at our equity value or enterprise value, at the end we can reduce this contingent liability to whatever we are crystallizing or arriving at before arriving at net adjusted value. In case of income approach, based on scenario, for example, suppose say we are estimate to give the example of that income tax demand notice only, we are clear that that will be disposed of in 2026 based on certain timelines being followed at income tax department for disposal of appeals. Then we are assuming that we may have to pay 20 crores towards this demand notice. Then in 2026 in FCFF only, like that free cash flow to the from water we are arriving there, we can adjust directly saying that there will be cash outflow because of this contingent liability. If we are not very sure about the outcome of in a particular year, then at the end we can adjust towards the contingent liabilities. For example, this mobiles, it is a 1 year warranty. So 1 year can be adjusted in next year cash flow to the company. Otherwise, there is a IP dispute or trademark dispute or something, that can be dragged for years together. Then that can be adjusted in the last equity value or enterprise value to arrive at net adjusted value. Any questions till this now? Because my presentation is coming to end for a practical discussion.
Fine.
With doubt, shall I?
Huh?
There is this company which manufactures aircraft parts. So that aircraft will take a, this indemnity kind of a clause wherein, the contingent liability could be humongous. Suppose an aircraft, some incident happens and it is identified that this particular part was malfunctioning. So that kind of contingent liability could be huge. So as a valuer, if whatever probability I assign to that, the value will become zero. So, but insurance, I don't know, could be there. So I'm like confused as to what should I do in case of
To answer your query, I did not disclose. I was working for this aircraft part manufacturing company only. There only like that project was shelved because of insurance cost only. What has happened, 5 million US dollars insurance cost, whether they have operations or not for initial years also, the foreign OEM was existing, take insurance, that cost itself is 50 lakhs per year. Whether they have operation. Sir, Harish sir, just, sir, Harish sir, mute yourself.
नहीं मैं तो बिल्कुल अच्छा कभी कभी ये होता है
Can
मैं
you
उम्मीद
mute
हरीश
Harish sir?
जी का फोन आया पता नहीं क्यों मैं कल कहीं बैठा था तो लगा अच्छा हाँ आप
Admin, can you mute him so that over, no? Okay, coming back to your query. So in case of this OEMs involved, foreign OEMs involved, and it is for like aircraft manufacturing, unless you have insurance, they'll not take product from your factory. Before giving order itself, one of the terms and conditions will be like you have to take third party liability insurance. With that only they'll take it out. But having said that, in case of malfunction, something they're identifying while assembling the aircraft and testing itself, that replacement cost could be very high. Maybe based on the past experience or like part cost, whatever they're manufacturing, based on that we need to assess and create for contingent liability. But generally, without insurance, they'll not place order on you. They'll ensure that there is an insurance for these products. Even they are aware of this.
So as a valuer, can I ignore this contingent liability in case it's a normal valuation?
If there is insurance cost, you can ignore. Because insurance cost will be very, very high. If you see their books, it will be very high cost.
Okay.
Okay. I'm displaying the contingent liabilities disclosed in Reliance Industries balance sheet for 24-25. This schedule, they clearly identified the contingent liabilities. This is where we need to look for the details. Suppose say they disclosed so many, it is into crores. For example, contingent liabilities in the respect of joint arrangements, they've already crystallized that much liability they've recognized in their books. In respect of others, guarantees also on behalf of joint arrangements, on behalf of subsidiary, all those things they're recognizing. Then again, if you see commitments also, they told that in respect of contracts remaining to be executed on capital account not provided for, we need to discuss with the management when it can be triggered. On March 25, they're not recognizing, but whether it will be triggering in 26 or 27 or 28. These are the details we need to sit with the management to spread, otherwise recognize one time or give whatever it may be treatment you can give in your valuation report to adjust your cash flow to the firm, then give your valuation. Otherwise, if you are not considering, you have to give proper justification or note why you have not considered, though it is disclosed. If you are ignoring and just signing the valuation report, tomorrow anything arises on account of this, then we will be into the trouble. Now they are disclosing like a note. They're telling that like there is a total outstanding demand for assessment year 21-22, 387 crores. Based on the decisions of appellate authorities and the interpretations of other relevant provisions of the Income Tax Act, the company has been legally advised that the demand raised is likely to be either deleted or substantially reduced. Accordingly, no provision is considered necessary. So this is where we need to use probability theory. They are telling it is to be deleted or substantially reduced. So that if they have obtained a legal opinion, we have to take that copy of legal opinion, how they have arrived at conclusion, whether they are giving any probability saying that based on these judgments, this could be the like outcome of this appeal. Otherwise, if first appeal we are getting stuck, then high court level or supreme court level, what could be the success rate? They may give in their opinion with disclaimers that we need to take and assess what could be the probable liability on this particular 387 crores and account for it. And this case definitely it cannot be done in a particular year, because appeals, how much time they'll take, if they're going for high court, supreme court, all those things, we don't know how much time it will take. So we'll need to adjust at the end of after equity value or enterprise value. Next, they're giving with SEBI. SEBI also, they told officer levied 447 crores. Then after that, they appeal to appellate tribunal. Appellate tribunal also confirmed the order given by officer. Then they went to Supreme Court. Supreme Court decided saying that you first deposit 250 crores in investor education fund. So already cash outflow accounted to some extent. Then the case is being fought in Supreme Court. Further things are going on. So 447 minus 250 at 197 crores is left over. In that 197 crores, we need to use probability theory to account for our contingent liability. What could be? It could be 5%, 10%, or 0%. But based on the facts of the case and based on the petition they filed before Supreme Court and based on the legal advice, whatever they taken for these purposes, we need to act judiciously, arrive at this, like what could be the one out of 197, what could be the actual liability. Because out of 447, already 257 crores they've deposited. So nothing to do with that. About balance 197 only, we need to take some theoretical approach to arrive at what could be the liability in future. Same thing they were telling, again officer has levied 25 crores. Appellate tribunal withheld, like no, confirmed the order issued by the officer. Then they went to Supreme Court. It is like against, like in the Supreme Court, it is pending. We need to assess again based on the petition, facts of the case, everything, what will be the total liability. Hope with this, my session is done with. Any queries we can discuss, or we can discuss normally on these contingent liabilities. Harish sir, you want to give any inputs here?
I think you have rightly covered. Here I would like to, give some background because in the next session, I will be covering on the same topic. What exactly the liability and the contingent liability? What percentage the trigger is there? The liabilities are divided into three categories. One is probable, possible, and remote. So this is not, random. They said there's a percentage decided. It was rightly covered by Mr. Chandrasekhar about the index number 37. And index 37 is talking about the percentage. It says if it is 50%, the probability of the liability is 50%. Do the provision in the books of account. No questioning of making contingent liability. You have to provide for that because the probability is 50% and more. Now comes 50% and less than 50%. Now here the game starts. Should I make the provision? The answer is no. It is less than 50%. Then it has to be shown as a contingent liability. Now it is appearing in the contingent liability. Now the role of a valuer comes. Because a valuation for accounting purpose and valuation for the sake of company's valuation. For financial record, we have a one valuation, Index 37. For valuer, it is over and above Index 37. So he has to look into in between 0 to 50. If it is above 50, already provided for. Then we have to look for a remote. So therefore, when we do the valuation, we try to get the bifurcation. Rajeshwar, your video is not appearing.
Sir, tell me, sir.
Yeah,
Switch
okay.
on. Okay.
What I was saying, normally at the start of the valuation, we look into we ask for a bifurcation of the liabilities. Normally, it is running into the notes to accounts. As a valuer, we start from the notes to accounts. They already provided for, okay, gone. Now, from there, we will try to get the probability. Probability will not be given just by the management. No, the probability is 10%. No, because it is the duty of the accountant, the auditor also, because he has to look into Index 37. If I promoter say 10% liability, 10% possibilities, no, the valuer has to get a opinion, tenability report. It cannot be given other than a valuer, a registered valuer cannot give a percentage. Only a law firm. There is a decided cases we will cover in our presentation. The law firm and only the Indian law firm, those are registered in India, can give the opinion based on such disputed matter. So the valuer has to apply, Rajeshwar has covered the option methods they have just touched upon. The option is basically probability. Who will give the percentage? Percentage will be given by a law firm. Or, for example, we have an expert in excise matter or a GST matter. Those who are expert in that, law firm. Why I am saying registered in India, there is a decided cases that the foreign law firm, I will not name Big Four because they are not registered in India. Their opinion will not be applicable or will not be binding. There is a judgment. If someone has new another judgment, you can share with us. But as on date, as a valuer, we have to very, very precautionary because the contingent liability comes into a play. It was rightly one example the madam raised about the aircraft, and the Rajeshwar has given the reply. Here, in such cases, where the chances of getting plus into negative. For example, the net worth of the company is 40 crore. The contingent liability is 100 crore. Now the role of a valuer plays. It's a big role because 40 minus 100 negative. Out of 100, how much you apply? And so that a very interesting scenario we will cover in our presentation. Just I would like to add, Rajeshwar, thank you.
Thank you, sir. Any question and answers people can ask. Harish sir is very expert. He has done.
No, not expert. Not I take the energy from you and then.
So we can take question
Sir,
and
Harish sir,
answers.
I have one doubt.
Yes.
Sir, how do you differentiate when you decide is it in contingent liability or provision? So as you said, I think like a warranty, provision for warranty, we make a provision. So when can be converted to the liability, then contingent liability. What is the thin difference, sir?
See, if the, for example, the warranty provision, warranty already identified, quantified based on your past experience. You have past data. You know what is the percentage of warranty, and there is a the standard says how to calculate the warranty for provision. There is a, in Indies, Mr. Chandrasekhar will be, happy to add. The Indies, the valuation of warranty can be captured. When it's already been captured, there is no need for going for a provision.
Contingent.
But,
Yes.
but if suppose you are not, as a valuer, you are not convinced because you are not an auditor. You are not doing the audit. You are doing the valuation. You can go beyond, because the valuation rules are above accounting rules, accounting plus valuation standard. If you are not comfortable with the provision, then the remaining part you can arrive at a contingent liability through option methods or through your probability, a judgment, because the valuation is nothing but a judgment only. So here, normally in the warranty area, normally as a practice, in our practice, normally we don't touch, because unless and until it is appearing in the contingent liability note, we start our valuation from the notes which are appearing under a contingent liability. Normally, warranties we don't touch unless and until we have some abnormal percentage provision.
But why it has not been made mandatory, sir? This valuation of contingent, why it has not been made mandatory actually?
No. Which is not mandatory. Mandatory is
valuation of contingent liability in M&A transaction. In any, is there anything where it's a mandatory or it's an optional actually?
Valuation? No, see, valuation per se is required only when there is a transaction. Okay, in M&A. Otherwise, there are two types of valuation. One is valuation. It is called financial valuation. We have a Indian accounting standards. We have a Indies. Every standard, there are 41 standards. Every standard is having a valuation mechanism, valuation method. Only it fair valuation. It covers, Indies is covering fair valuation only. It is already fair value. But the valuer is not doing accounting valuation. It is a valuation for a purpose, for merger, for acquisition. It is not for accounting. So there are two valuation for accounting Indies. Over and above accounting transaction, then you have over and above the valuation for that purpose only.
Thank you. Thank you.
For all the benefit of the participants, as Dhamija sir already announced, he will be taking contingent liability valuations in a practical manner using Excel sheet and that probability theory, all those things. And BWay will announce soon to you. So you'll be much more benefited by that session. Till then, you can...
Yeah, you can send the question in advance
thanks
to me.
in advance, actually, to Mr. Harish.
Sir, all the participants are requested to send their queries in advance. Sure. So that I should modify my presentation to cover for the benefit of all.
So kind of you, sir. So kind of.
Okay. Right.
Sir, any other questions, participants? Then we can conclude also. Though it is, so you are privileged, you are ending session early to start your day early today.
I have seen only one video which is on, Mr. Anjum. Go ahead. Other participants may not be, I don't know the reason. Normally, I prefer, that the person who is there as an attendee should put their, normally this is, can you make it some sort of SOP that, it looks, even though in the morning it is difficult to get ready and to, make themselves. Nidhi, I have seen, Mr. Kazi. I think we have interaction with Mr. Kazi. I'm just recalling. Okay. Okay. I think
That's a nice one. Nice one. Just 2 minutes, sir. Just. Vijay, you are there? Hello.
Hello. Yes, sir.
Yes, sir.
Thanks to both the speakers, for a wonderful session. Actually, I could see there a lot of, they have taken a lot of pains to prepare the slides and explain in detail and each and everything with the steps and other things. So really thankful to Mr. Chandrasekhar and Mr. Rajeswara Rao. Our sincere thanks. And also Mr. Harish Damija, to pitching in at the right time. And we are extremely grateful to you, sir, to have, we are really honored to have you here, actually. I know we have read your books and all. So we sincerely thank. And as part of our token of appreciation, we present this memento to Mr. Chandrasekhar and Mr. Rajeswara Rao. We are happy to present these mementos. It will be couriered to you, sir, to both, actually. We are extremely thankful to you, and we look forward to the next session of Mr. Harish Damija on November 8th. Certainly, I'm sure most of the people are already excited. Certainly, we look forward to a lot of takings from you, sir.
Thank you, sir. Thanks, BB, and thanks all participants for good interaction.
Thank you so much, sir. Thank you so much.
Thank you, sir.
Thank you.
Thank you, everyone. Thank you, all participants. Thank you.
Thank you all. Have a good day.
Okay, sir.
Thank you.
Thank you, sir. Thank you.
Thank you.
Thank you very much, sir.
Yeah,
Looking forward to the session on November 8th, sir.
Okay.
Right. Thank you.